Great. Thank you so much, Vas. Hi, everybody. Okay, so looks like everybody can hear me.
Yep,
Um, so how much time do I have?
an hour.
An hour. Okay. So what I'll do, I do have a substantial number of slides, about 30. Typically, it'll take me about 30 minutes to go through the slides. I will plan on blowing through some of them really fast. But I would encourage everybody to just ask questions as I'm speaking, and not just wait till the end, because then we can have a very contextual conversation. Uh, so the way I've designed this presentation, the goal really is to provide an experiential perspective on how AI and digital transformation are impacting insurance, and what we can do about this.
Jerry, are
So
you do you want to go full screen or do you want to keep it like this?
I can do full screen. Is this
Yep,
better?
yep, yep,
Okay.
yep. Thank you. Awesome.
Absolutely. So, so as part of that, I'll talk about what's driving AI today, how it is impacting insurance, and what insurance can do. One of the things that people probably don't know about me is I have experience in different industries. So it's not just insurance experience. I also have experience working for the big tech. I used to be the head of global programs at Amazon. And so I have firsthand knowledge of how big tech and the digital environments work. And frankly, it's not rocket science, right? There's no reason why insurance companies, legacy carriers, cannot adopt the same practices. So I'll talk about that as well. So, what are the drivers of digitization and AI? I mean, it's really you know, three core elements, which is changing demographics, which is a rapidly growing smartphone adopted market, urbanization, and sort of a digital first mindset of a lot of the younger millennial, Gen X, not Gen X, Gen Y and Gen Zs. Obviously, there's sort of a um, uh, we are at an inflection point when a lot of the technologies are starting to achieve maturity, be it IoT, be it mobile devices, and now with 5G, this is just going to accelerate even more, right? So you have, and then obviously the customer, right? The attention span of customer is reducing, their shopping behavior is increasing. So what that means is um, um, we need to engage and um, we need to get the attention of the customer, engage with the customer, and convert or a user and convert that user into a customer very quickly. We don't have the time. Once the customer leaves your environment, the probability of that customer coming back is very low. The second thing is the customer's attention. So the attention span is very low. The second is the shopping behavior is increasing. So the concept of customer loyalty is not that strong anymore. So the mindset insurers and legacy companies need to have is every day is a customer retention day, right? You can, typically it used to be you would get a customer, the average tenure of the customer was going to be in the insurance world was going to be about 2.5, 3 years. Only 40% of the customers shopped on an annual basis. You are a 60% loyal customer base. So your goal was to increase that 60% or retain that 60% customer base. You knew the 40% of the customers, about 15% or 10% of them you would lose, or about 20% of them you'll lose. So as long as your average retention was above 85%, you are good. That's not the case anymore. Every day is a fight. And what that means is you have, as an insurance company, you have to be super um, aware of impact of automation, disintermediation, mobilization, and virtualization on your world. So when I was at Amazon, I developed a framework on how to compete in the digital world, and it's a very large handbook, so won't go into that. But one of the frameworks I have is called the SIFT framework, which you see at the bottom here. What it basically means is for any product, service, or solution to succeed in the digital environment, it needs to have one or more of the following elements, right? Which is the SIFT framework. It needs to be simpler than what currently exists. it needs to be more innovative / more interesting, which is the engagement piece. If it's not, it doesn't engage the customer's interest, um, 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 you're not going to succeed. It has to be faster than what exists right now, and it has to be more trustable, right? Transparent, trustable, right? So it's the SIFT framework, really powerful framework. You need to have at least one of these elements, ideally more than one. If you don't have any of these elements in any offering or any solution or any product that you're launching in the market, you might want to rethink what you're doing or how you're going about this. What's the current state of AI? What's the current state of data? It used to be the wild west, but I think we are finally getting to a stage where I think regulations are kicking in. The problem, however, is there's a proliferation of governance frameworks. So you have the GDPR in the EU, CCPA in California. You have the FN something in New York, mostly for financial services, which we are party to because we are financial services. And then you have different regulations in China, in Saudi Arabia, in Bahrain, and other places. So there's a proliferation of governance frameworks, which increases the cost of compliance for companies. And so I think there's a movement or a desire to standardize these. But there's a competing pressure around, we have been moving towards a globalization over the last 40 odd years. And now there's sort of a little bit of a movement towards deglobalization. So it remains to be seen how it impacts this. But regardless, the cost of compliance, one should expect to go up around data. We're already seeing AI skills already exceed the skill level of 80% of people. And the important thing is, it used to be that it was normal routine tasks, but now we are seeing some expert level skills being automated as well. So machines are making better decisions than human beings, right? So if these are standard transactions, standard underwriting, machines are making better decisions, and it's empirically proved. When it comes to bespoke risk, humans are still required, right? So what that means, white collar automation is accelerating, and I'll show a slide later on. But underwriting, every single function within insurance right now has the probability of being automated. It's still a binary battle right now. What's relevant for us, obviously, is the big tech versus the rest. As insurance companies, we are already starting to feel it. If you do any direct to customer marketing, and if you do Google ads, you'll realize that your cost of customer acquisition is close to $600, right? 10 years ago, when we were doing social media marketing, our cost of customer acquisition was much less. But now insurance is the most expensive keyword on Google ads. So the cost of customer acquisition via social media is pretty much the same as television. So that's why you see insurance companies still relying so much on television. This is not important, but basically it sort of gives you a sense of how much data is being generated on an everyday basis. This is an old slide. This is from 2019. So these numbers have changed. What does it do? So digitization is the prerequisite for AI, because digitization creates data and data creates AI. So one cannot have the other, but one cannot have AI without digitization. Now, you could buy data from external sources, but that becomes really expensive. So theoretically, ideally, you should have your own digitization capabilities. So it's a virtuous cycle where the more you digitize, the more data you collect, the better algorithms you're able to build. The better algorithms you're able to build, the better decisions you make, and the better decisions you make increases your ROI, which releases more funds for digitization. And so it becomes a virtuous cycle. And obviously there's a corresponding increase in your cost structure, which increases in lower prices and so on and so forth. Now,
so Jerry, a quick question here, right? So here in terms of data, and here in terms of kind of pushing things, the things around. So what would you say would be the starting point, right? So maybe for someone who's smaller, who's working with a lot of partners, right? Maybe they do not have the large data set of their own. How would you say that you can build sort of the ecosystem for this digitization and AI and data, what are some of the best practices that you might recommend to our participants?
Hold your thought. I will come to that.
All
Is that
right,
okay?
sounds good.
Yeah,
All right, yeah.
I'm going to come to that. Yeah, and yeah, that's a really good question, and I think I'm going to spend a lot of time on that, because what I would have told you 4 years ago is different from what I'm going to tell you today. I teach data science and artificial intelligence at MIT, and I also teach it at London Business School. And so over the last 4 or 5 years, and I also teach data science to insurance executives. So at Swiss Re, we have an offering where we teach data science to insurance executives. So I have a lot of data points through that, which sort of gives me the ability to sort of address that question. So this is the virtuous cycle. And what we're seeing is ecosystem platforms are the ones who are really extracting the value, right? So if you look at the vertical ecosystems, these are the online marketplaces in the different industries. But then look at the horizontal ecosystems. I don't know if you're able to see my cursor, but the horizontal ecosystems, this is where the real value is, and this is where there's an extraction of value by the different ecosystem players. If you, those of you who are doing, infrastructure in the cloud and everything as a service, you will see how quickly it adds up. I'll give an example. Just a few months ago, we were talking about a new solution at Swiss Re that I'm releasing very soon in the market, fingers crossed. And we were talking about plugging in different as a service or service-based providers into it. And very quickly, even the simple services, they sound really cheap, 1%, 2%, 3%, 4%, 1%, right? But with the amount of services that you end up adding, very quickly, the cost of the services was reached about 45% of premium, right? So as insurance executives, beware, right? Which is, the services seem benign, they seem cheap, they seem really helpful, but they stack up and the costs become very high. Okay. And obviously, all of us are in the situation where we are seeing that the data owners are extracting all the value, right? I just caught the last 5 minutes of the previous speaker who mentioned we have more data than we realize. That has actually not been my experience dealing with insurance companies, especially if you are medium to small insurance company. That is definitely not the case. Even if you are a large insurance company, you have a lot of data, but that data is biased. So the decisions you make based on that data may not be as accurate, right? You will never have the level of data across different touch points, across different experiences that someone like a Google or an Amazon or a Facebook has, right? So we have to be aware, cognizant of our deficiencies and seek to address them. Now, we talked about this slide where we said there's an adoption acceleration, and now I'm going to start addressing some of the questions, one of the questions that was raised, right? Which is, what are we seeing in the insurance world, right? So in general, in big tech, we have these virtuous cycle of AI and digitalization, each reinforcing each other, increased ROI. In the insurance world, and not just the insurance world, in about 90% of the companies which are not big tech in nature, we are seeing the opposite. We are basically seeing a death spiral, a vicious cycle of underperformance. What's happening? So what's happening is we are living in a resource constrained world. And so that was part of the question that was asked, which is, if you don't have capabilities, what do we do? What are the resources that we need? We need people, we need technology, we need data, right? We need the processes, we need the infrastructure, right? So resource is a really big issue. There's about a 200,000 person shortfall every year, and that is accelerating. So the reality is, majority of us will never have access to quality talent. Let's accept that reality, right? Empirical evidence from my own company and from others I've spoken to, especially in the sexy businesses like insurance, excuse my word, has been that we hire expensive data scientists who are fairly new, We train them for a couple of years. We train them to build some new models. And then after 2 or 3 years, they get picked up by startups. They get picked up by consultants. They get picked up by other companies. Google, Amazon are hiring a lot of insurance data scientists because they are looking at insurance, right? So what we are basically doing as insurance companies, we are training the people who are actually going to go out and fight us in the future, right? Insurance companies, by and large, don't have the ability to retain talent because why is that? First of all, because we are resource constraints, we don't have the people, we don't have the infrastructure, we don't have the data. It takes us a really long. Are you all able to see my cursor? Hello?
Yes,
Yes.
we are.
So because we are resource constrained, and this is all based on empirical evidence, so this is not something that's theoretical. Because we are in the insurance world and really the legacy world, we have resource constraints. We have a very high development integration time, right? So when I was at Amazon, we were building about, admittedly, there were small models, but we were building about 2 or 3 models a month, right? So very fast time. I will tell you, they were really small models, so it's not apples to apples comparison. But because there was a lot of data, there was existing libraries, we were able to do it. In the legacy world, especially insurance, it takes about 6 to 8 months to build a model and deploy a model, right? Very high development time. Result of that is the deployed projects are very small, right? In the legacy world, 85% of all models fail. 85%, that's a huge number, right? So now, not only did it take you a long time to build a model, but there's an 85% chance it's never going to be deployed, right? Okay. What also happens is the maintenance costs of models is really high. It is especially high in regulated industries such as insurance, because we have to make sure the model is not biased. We need to make sure the underwriting risk or the underwriting is within a certain tolerance level and all of those things. So what happens is there's a very high model maintenance needs, which means a data scientist is not able to create too many new projects which are deployed. And so he or she is either doing model maintenance, which they hate, by the way, or they are building projects that never get deployed. What that does is it creates demoralization of the talent, which leads in talent attrition. And again, then you go into the vicious cycle, right? Those people leave. Because you don't have an ROI, it's that much more difficult to allocate more money to this, makes much more difficult to attract people. We have seen, again, firsthand evidence, we have seen big insurance company, I'm not going to name it, who lost an entire 8% data science team after the evaluation, the performance evaluation in 2020, because they just didn't have the kind of ecosystem that could nurture them, support them. Okay. The other issue that we are facing in the insurance world is the data scientists we do get from colleges and other places. They may be good data scientists, but they don't understand the business. So either they're building models that cannot be deployed. For example, we have a very high requirement for interpretability in insurance because of regulatory reasons. We need to understand why the model is making the decision is making, and underwrite the data scientists are more geared towards accuracy and other performance metrics. So there's a disconnect. They build models that we cannot deploy because they don't understand the insurance world.
Jerry, question here. So the first question is, so do you think it is more on the consumer side, if you will? So meaning that like the problem is that we have all the data, it's all accessible, it's all good, but we just need to build a model. So do you think it's more on the data engineering, data processing, data accumulation space? So where do you think that is?
So it takes the 80% of an effort, 70 to 80% of the effort in a data science exercise is in, and let me go to my slide, I'll show you what it is. So let me do this, right? So let's go to the next slide, right? So if you look at this slide, most people think that model ops, this is data science. No, Data science starts from data ops.
Mm-hmm.
Model ops is 10 to 15% of the entire effort, and then DevOps. Okay. So data ingestion, exploration, wrangling, labeling, splitting, that takes up about 80% of the time. And then, which is a big, so if the average cost of a data scientist is $300,000, and 80% of the time is spent on this, right? So $240,000 per data scientist is going in this, right? This is not a value add work. Well, this is, let me correct myself. This is not the kind of work that your expensive data scientist should be spending, right? Then there's the model ops piece. This is where this is the time your data scientist should be spending, but it's only going to take 10, 15% of his or her time, right? So theoretically, if it's only going to take 10, 15% of his time, they should be building more and more of this, right? And then there's the ML, which is continuous improvement, monitoring, because every complex model will creep. What it means is results will change based on new data and all of those things. So how does it work? In terms of numbers, how does it work? On an average, it costs about $650,000 to build a model in the United States. In Europe, my understanding, it's even more expensive, right? The average failure rate is 85%, right? Your average data science team, when I say a data science team is composed of 4 people. There's a data engineer, there's a data scientist, and there are 2 DevOps people, right? That 4-person team on an average will cost you about $1 million. And this is salary, not fully loaded. Fully loaded is much higher, right? So it's going to cost you about $1 million. It takes about 8 months to build a model. So it's going to cost you about $650,000 to build the model. 85% of the models you build are going to fail. And then when you do build a successful model, on an average, it's going to cost you about $200,000 a year to maintain it, right? Because typically 30% of the time it took to build the model will be needed to maintain it. Now, I'm using the 30% number. If you look at MIT Sloan, which is a big university here in Boston area where I'm from, the number they give is 1:100 ratio, right? Which is for every dollar you spend on building a model, you should expect to spend $100 over the lifetime of that model, right? So if you take that number, then the lifetime cost of a model is $65 million. Did I? Yeah, $65 million, right? So, but they include a whole lot of other costs we are not including, right? So what are the failure modes in large insurance companies? The failure modes in large insurance companies is data scientists want to be here, but they're spending majority of the time here and here, which results in loss of morale. They're not interested in all of those things. The market is really hot for data scientists. So the minute they put their resume on LinkedIn, someone's going to pick them up, right? So what do you need to do to keep them here? So the question was, what are some of the things that can be done, right? So again, in full transparency, we have a service we call Data Coach as a service at Swiss Re. Basically, we optimize people, process, technology because we are seeing the gaps in the market, and what we try to do through this service really is to provide pieces or whole of these services in a manner where you are not spending $1 million a year on a data science team. You may spend less, and more importantly, you're not spending $200,000 a year on maintenance costs. So think about this way, right? If you're spending $200,000 a year on maintenance costs, once you build 5 models, your data science team is fully allocated to maintaining the existing models, so they don't have the time or the bandwidth to build new models. Very frustrating, right? Here you are, you're spending $1 million a year on a data science team, 4% data science team, and once they have built 4 models, they can't do anything more, right? And so you have to be cognizant of that.
Awesome. So maybe a question we have Pamela in the group who's really focusing on the data and technology and all of this. So Pamela, do you agree with kind of that circle that Jerry showed, or you think of maybe about something different? So like from your perspective, from the Italian technology perspective, how do you see it from your spot?
That's definitely true, right? But I would say that the challenge is going beyond insurance to attract data science and talent. One of the strategy we're trying to put in place is kind of, lowering a little bit the level of expertise that is needed for simple use case and application. You were mentioning maintenance, right? And I'm not using the buzzword low code, no code, but that's kind of democratizing a little bit the usage of tool. Open source is doing a lot, I feel, right? Because it's kind of educating a lot and training a lot of people that can do simple stuff, right? So even if not the modeling, but I think that there's several opportunity in the first column you had, right? So the operational part, and that's related to the fact that there's the elephant in the room, which is the data quality. And when it comes to insurance and reinsurance, even if we talked a lot about digitalization, there's still a lot of poor quality documents, right? So semi-structured documents, scanned documents, handwritten documents, these are still representing big bunch of the inbound communication, I would say, right? And data cleaning is still representing a lot, right? So I'm wondering, is there, are some technologies doing good progress in that area, so that do you see like a trend in decreasing this 80% of the percentage of data science in this area, or is still too slow? And is kind of, open insurance kind of helping that in this direction, right? So I'm thinking about standardized type of documents and the like.
Yeah, there's a little bit of standardization over the last 5 or 6 years. So we are hearing now that in some cases, some of the more advanced teams are only spending 70% of their time because they have access to better data and stuff. There's a lot. We evaluated a bunch of low code, no code solutions. So, for example, Data Robot, H2O.ai, and others. And frankly, we after using them for 3-4 years, we discontinued the use. And the analogy I give, Pamela, is, let's say you get on an Airbus aeroplane, right? The plane flies by itself. It's fly by wire, right? And so you get on the plane, then this person gets on the plane and says, hey, I'm a truck driver, and I'm going to fly this plane because, by the way, the plane is going to fly by itself. I'm just here. You're not going to trust that, right? You're going to walk off the plane. And we saw the same thing with Data Robot, where we had our cognitive data scientists building data models using Data Robot, and they had no way of proving that, except the fact that, Data Robot said so, right? In the insurance world, and in any situation, to be honest with you, right, you need to be able to explain why the model is making certain decisions. You need to be able to rely on it, right? So we have abandoned that piece. I think for simpler models, yes, you could potentially look at it, because the risk of, if the cost of failure is not high, you could adopt it. But I think the risk far outweighs the benefit, because we are starting to see movement in the area of AI bias liability, where companies are starting to get sued for making decisions using AI, right?
We are expecting in Europe the AI Act coming out, right? And probably in the US will follow, right? So yeah.
Yes, and then in the UK, they already have what they call the AI reserve, which is every company needs to have a reserve for AI decisions they make. So this is a big issue, and so once this comes, I think it's going to be even harder to use these drag and drop black boxes. The other is the data cleaning, data curation. There has been a huge amount of work in that, including myself. I've done a lot of work in that around automating the knowledge graph, or automating data labeling and stuff like that. The results have been patchy. So the company right out of MIT here in Boston called Tamer, which claims to do that and all of those things. But when you look at the reality, you still have to build your knowledge graphs and your knowledge trees in advance. It's still manual. Yes, they will automate the labeling later. You still need to have manual review of those labelings. So it is a non-trivial task. We don't anticipate any changes in the data labeling, data curation space, at least in the next 4 to 5 years. Data labeling, I caution people when they talk about automating data labeling, because data labeling, the quality of your data labeling indicates the quality of your model. If your data labeling is not good, your model is not going to be good. And data labeling is one exercise that requires a huge amount of human judgment. Okay, I'll give you an example. So we just did a project where I'm building a credit default model, right? And one of the data items, one of the features was credit score. And in about 90% of the cases, the credit score was missing. And so my data science team said, oh, we're going to get rid of it. 90% missing values, it's not going to provide any information. But then we spoke with the business team and we discovered that the credit information is collected only when the underlying company is suspect, right? Its financials are not that good. So actually, our data science team initially thought companies which has the credit information is actually a good company. Companies which you don't have is a bad company. It's the opposite. They were going to get rid of it. So we converted that continuous variable into a binary variable, 0 and 1, right? Which is a company with 0, which has no credit score, actually has a good financial profile, and 1 which has a credit profile, right? The answers were totally different. If we got rid of that column, the answers were different. We were getting about 68% accuracy. When we converted into binary, we are about 74% AUC right now, right? So even if you automated, I think it will raise more questions than it will answer. Okay, and then the other thing, Pamela, is in the United States, in certain states, for example, California, when you do rating for motor insurance, automotive insurance, and when you pull in your features to go into the rating, you have to pull them in a certain sequence, right? So if you try to automate that process and have Data Robot build it or someone else build it, they're not going to know that. You need to have a data scientist who can pull these things in certain sequence to comply with regulations. So I'm sorry, but the answer to your question, Pamela, is there's no near-term solution to these problems.
Okay, good. Thank you for your perspective. Really helpful.
Absolutely. All right, let's go back to the screen. Can everybody see the screen again, this slide?
Yep.
Okay. So now we talk about the transformation urgency. And again, I'll go really fast. During the Industrial Revolution, we saw the automation of the physical tasks. Now we are seeing the automation of the mental task or intellect. And from insurance point of view, it is impacting every single element, right? From product development to pricing to distribution to policy claims management. And this is a heat map of how significant the impact is, right? So on the x-axis, we have the insurance value chain, right? Product management, marketing, sales, underwriting, blah, 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 finance, accounting. And then under that, on the y-axis, we have processes or individual processes in each part of that value chain. So it's pretty comprehensive. And then we say, if it's dark blue, AI has made a significant impact. If it is light blue, it has made medium impact. And if it is sort of clear, it has made low to no impact, right? And I started tracking this about 6 years ago. And I would only see 1 or 2 dark blues. Look at the number of dark blues. Then if you look at this section, which is the policy acquisition and servicing, till about 2 years ago, all of this was low impact. Now all of this is medium to high impact, right? So if you look at the underwriting, it's all blue, right? So the impact of AI in the insurance value chain is very pervasive, and it's getting deeper. The area that is probably going to be the next in the list is finance and accounts. We're already seeing automation of bookkeeping, where your AI systems are automatically able to make debit and credit entries and so on and so forth, commission processing and all of those things. So the impact is pervasive. What that means for you as insurance companies is, if you don't have these AI driven tools built into your company, you're not going to be able to compete in the market, right? So the gap between the rich and the poor is going to get bigger and bigger. It's already getting bigger and bigger. Now, then the question is, okay, how do we address it, right? There are, you know, three ways of addressing it, right? In any situation, right? Typically, it's called build versus buy. I will add the third element. It's build, buy, rent, right? So what is build? Build is you hire data scientists and they will come in and they will build it. We now know from empirical evidence that that's not a viable solution. If you try to build everything yourself by hiring your own team, that is not a viable solution, right? The final element, the third element is buy, which is, hey, we will take claims from Auditex, we will claims AI from Auditex, we'll take underwriting from Guidewire, we'll do this from this from that. I think if it is a, first of all, it gets really expensive. I gave an example where once we added up all the services that we needed, our loss ratios were hitting 45%. Sorry, not loss ratios. Our expense ratios were hitting 45%, right? Without any of the, you know, salaries and any of the, just the service costs were 45%. And in a high loss ratio environment, you can imagine how difficult it becomes, right? And we didn't even factor in this out. So buying is super expensive. And then again, when you build versus buy, you also have to do a balance between generic versus strategic. If you want to do, if something is of strategic importance to you, you definitely don't want to be buying it, right? Because now you're transferring knowledge, now you're outsourcing something that's critical to your business, you're not going to succeed in the long term, right? Then the medium is what I call rent, which really is building some core capabilities in-house, but supplementing it with the right team, outside team, to enable your things, right? And so this is the service we have started at Swiss Re. I'm actually not trying to sell the service because it's a fairly new service. I'm just trying to say that we are seeing some pain points in the market, and we are trying to address it because we know that it is not in the interest of the market to have some of the smaller or medium-sized partners go out of business because competition is good for the market and for everyone, right? But if the status quo remains, you know, the analysis from McKinsey is by 2030, 60% of Fortune 500 companies today are going to go out of business. And we are talking about Fortune 500, which have the money to hire data scientists. So, you know, these are some of the things we have at Swiss Re, which is, this is the parametric insurance for flight delay. So we are already using it, fairly successful project. This is a company called Beam, not affiliated with Swiss Re, which has embedded insurance in its IoT devices. We are already seeing embedded insurance in cars, Tesla, Volkswagen, not Volkswagen, Tesla, what's the Swedish car? Volvo, and others, right? And that really means that, you know, we as insurance industry, we need to sort of move further along that space. And how we do that is up to us, right? Build versus buy versus rent versus partnerships and stuff like that. But there needs to be a certain amount of inevitability that we have to move towards automation and data analytics, right? So it's about scalable systems, API or service-driven architecture, superior knowledge, data-driven, and agile culture. I cannot emphasize to you enough the importance of culture. Studies after studies we have done at London Business School show that culture is the most important attribute of digital transformation and AI transformation. And we talk about companies like, if you look at case studies, you can look at Domino's, you can look at Schneider Electric, you can look at T-Mobile, you can look at Vodafone, you can look at Deutsche Bank even, right? So we talk about legacy companies which have somewhat succeeded in this modern world. They have changed their culture, they've become data-driven, and they have embraced a ambidextrous way of thinking, right? I do recognize the insurance industry change is not easy, right? We have a very large turning radius, and we also have to be cognizant about our regulatory risks, organizational constraints, and consumer risk, because we are a customer-facing brand. We do, we are risk averse. We do face issues related to privacy and all of those things. So not to say that challenges don't remain, they do remain. And obviously our organizational behavior is, I think a lot of you have heard of innovator's dilemma, which was coined by Professor Clay Christensen here at Harvard. And it's difficult for executives to think about disrupting things when they're so focused on optimizing what they already have. But again, I don't think there's a choice anymore, right? And I told you about 60% of the companies will go out of business in the next 10 years. And if you look at from the past, only 12% of the companies that were Fortune 500 in 1955 still exist, right? We all know the examples of Netflix, not Netflix, Blockbuster, and others. So it's important, right? And then how can we start thinking about it, right? We have to look at a different way of our entire insurance value chain, be it distribution, be it product, be it ops and IT, right? I talked about how social media marketing is so expensive, our television marketing is so expensive. So yes, marketing is expensive, but in the new world is the customer experience, is authenticity. Authenticity, which translates into trustability, is the single most important criteria for modern customer, right? So if you are able to build a trustable, authenticity-driven brand, people come to you. Look at Chubb, look at USAA. They've built that brand. The product cannot be static. Needs to be more customized, UBI and things of that. And then obviously your ops environment have to be flexible and agile, right? Okay, these are some of the business models. And again, a lot of people ask me how much time before AI pervades everything. So try to link it to Cambrian explosion. It's actually not important for this session. I don't think we need to go there. But if you look at the analogy of the Cambrian explosion and all of those things, we are less than 25 years from a really AI-driven world. So I'll pause here. We talked about AI drivers. We talked about pervasive insurance impact. We talked about transformation urgency. We also talked about some of the tools and techniques you can use. I'm happy to stay on and answer any questions you might have. So I'll stop sharing.
Awesome. Thank you so much for giving a very interesting and very detailed perspective. So does anyone have questions? And I know that we have people who are less on the technology, more on the technology. So I would really like to hear if anyone has anything to say who's maybe less on the technology and trying to understand, okay, how all of this can apply to their business, and maybe we can discuss that with Jerry. So anyone, please go ahead. Don't be shy.
It would be good for me to also get a sense of which companies are here today.
I can say something, but not sure if it is focused on really on what we have really discussed. But I'm from Chubb, okay? Just to give you the answer to Jerry. And Chubb is quite on top of this, not only in consumer, but also in commercial.
Yep.
We have discussed that we have a lot of data and we need to work on these data with the process you have described, machine learning, data science, and so on. But my curiosity is why we are looking at these data that have been collected ex post, because we already have this data, because this data from our insured, and are collected in a, let me say, quite confused way. In fact, Pamela told before that probably there is a lot of mistakes in the data. Why we spend so much time in working on this, let me say, old data, and not we focus on where we can find new data? Because I have in mind that if I need to do a risk assessment, I would like to know from external sources in an automatic way, let's say certificate or not, which are the data that for our insured. So I think there are a lot of entities that have their own database, and probably they can share their database with insurer or with other possible users. So if I want to know, very simple, the value of a building of my insured, but also if I want to insure a new person for which I would like to provide him a property policy, why I need to profile him according to his answer and not to find out how much is the value of his building from getting the data from his insurance, from tax not requested, tax payment, let's say, you know. In the tax authority, you can pay taxes based on the value of the building, let's say, in terms of revenues. I don't know if in US it is the same as in Italy, but every year the government say your building value, commercial fiscal value is this, so you have to pay tax on your home. Why we don't focus on how to get information from tax authority database, let's say, or other sources, external sources, to provide an offer to our prospect and say, hey, I know that you have a building which value 1 million. I have the right insurance for you, and you already go to him because you are updated on his needs, and you provide already the information. Probably he didn't know, or he don't know that his building value is 1 million. He probably think that the value is 1.5 million, let's say. So I don't know if this is a different point of view, because we are focusing on all data, but we can have the possibility to get new data.
Yeah, so I think there are two elements to your question, right? One is a priori data versus ex ante, right? Which is, why do we as insurance company focus so much on a priori data, which is essentially historical data? And so should we be relying more on ex ante or basically predictive data? The answer is yes, especially if you look at the areas of cyber insurance. That's absolutely the case. Historical data doesn't really tell you much because everything changes on a minute-by-minute basis. And I'll submit to you, it's probably going to be the same about automotive data, because automotive data prior to 2013 is irrelevant, because the cars prior to 2013 were different from cars today. Just to give an example, the average loss on a fender bender in prior to 2013 was about $500. Pre-deductible, and today it's about $22,000 post-deductible, right?
We lost him.
So if we use data from, I think we are probably going to be underestimating it. Same with housing, with the climate change and stuff like that. We are seeing changes, though whether it's sustainable or not is different. So that's one point. The answer is yes. We should be looking more at ex ante data more and more, but that requires a certain level of sophistication, requires a certain level of comfort, which I'm not sure the actuarial world has at this point of time. The second question is around using different data sources. The answer to that is pretty simple, right? So in a lot of cases, regulators, at least in the United States, limit the kind of data you can use. For example, if I'm writing a home insurance for you, I cannot use your credit information. Most states, not all states, most states prohibit that. And tax data is something that United States, at least in the United States, that is sacrosanct. Even courts have difficulty getting access to that data, right? So it requires a lot of prior consent and all of those things, and getting transcripts and all of those things. It's not an easy process. So, but can we get more access to more data? Absolutely. So when we look at data, there are two types of data, right? One is intuitive data, one is non-intuitive data. Intuitive data is data that we think, based on our observations, will be helpful in making an insurance decision, right? So, for example, if I'm underwriting your health insurance, intuitive data to me is, what do you eat? Do you smoke? What's your age? What's your gender? What's your ethnicity? What's your race? What's your country? Right? Those are intuitive data. What's your socioeconomic status? But there are non-intuitive data as well, right? Which is data you don't think is related to this, but could be. Guess what? Education is the single biggest predictor of risk when it comes to an individual, right? A lot of times when you make life insurance decisions, you don't use it. You definitely don't use it when you make health insurance decisions, right? There have been studies done which show the color of the car you drive is related to your risk-taking behavior, right? So, and risk-taking behavior obviously is related to your health, because if you're a risk taker, you're probably smoking, probably drinking a lot, and all of those things. So you're exactly right, right? Which is, we should be tapping into more data sources. It's not easy, but we should be. And then we should be looking at predictive elements, not just the historical data, which probably is incorrect at this point of time.
Thank you very much.
I have a question, Jerry, and it's a kind of crystal ball question or prediction in terms, which is the role that you think reinsurance can play in terms of the data? So you mentioned the data coach as a service. Is it a service you're offering to your stakeholders and partners, or is it an internal service, right? And I know, I mean, I've collaborated with Swiss Re, so I know in terms of, privileged position I was referring to is the amount of data you have available, right? And the resources and the time, and it's a privileged position, right, if compared to other carriers or incumbent. And I'm wondering if playing the role as a strategic consultant in the data practice specifically is something that you're thinking of, or you can see as strategic.
Yeah. So as you know, our primary motto is creating a more resilient world. And as part of creating a more resilient world, it is super important for us that the insurance industry remains profitable, buoyant, and progressive, right? So what that means is we have seen different industries where there's been a massive consolidation, and that consolidation has hurt the customer, right? In the insurance world, I think I feel it's super important that the level of competition remains high, so that unique products are made available to customers who have choice, and they're able to pick the right. We are seeing consolidation already. The private equity players buying up insurance MGAs. They're buying up insurance brokerages. So a lot of the independent brokerages have been bought up by large private equity players. What that really means is it's going to put pressure on carriers, because they're going to raise commissions once they have that inflection point, right? So in order to create resilience, we want to enable even the smallest of the small insurer to be able to compete with the largest of the large insurer, right? So data coach as a service, you're right. We have a lot of data, and the amount of data we are adding to our data ocean is mind-boggling. We just had a meeting right before this meeting, which I had to leave early, unfortunately, where the amount of data we have from different sources globally is something that's very impressive. So data coach as a service is a service we have launched. We had a pilot customer early this year, very successful project that we are targeting towards insurance companies who can engage with us, and based on their price points, based on the level of needs, we can provide the level of service that they need. Now we're working with a third party, but it's a very curated, very well designed service in my my mind, where unlike traditional consulting companies, we don't start at a $200,000 price point, right? So if you talk to some of the larger consulting companies, the price points are prohibitive. And the second thing is they don't have a skin in the game. We put a skin in the game, so we make sure incentives are aligned, right? Because if we build a model for you and that model is used for you by you in insurance underwriting, and you happen to cede some of that to us, it's in our interest that what you deploy reduces in good pricing and good risk, whereas the consulting companies don't have that incentive.
Makes a lot of sense. Thank you.
Awesome. Do we have any other questions? All right. If there are no other questions, Jerry, thank you so much for giving that perspective and really just taking us a little bit one step up from the particular solution and actually showing, how you and your clients and your partners think about the data and AI. So thank you so much for joining us today. It was a true pleasure. I hope you have a wonderful rest of your day.
Thank you for having a blast. Nice meeting everybody. Have a good one.
Thank you.
Bye.
Bye. Thank you.
Bye.
All right.
Bye. Thank you.
Yep.